Hello, everyone. So get this out of the way. I am not wearing this specifically for this class, although it's appropriate to what we're going to be talking about today. We're going to be talking about risk assessment, but we actually talked about Enron in my graduate course today. I know you all have heard about Enron. Has anybody actually done a deep dive into the Enron case and learned about everything they did? It's 23 years gone, and it's still fascinating. Still fascinating, all the crazy things that used to happen there. It was a much different time in accounting and a much different time in auditing, but yeah, it amazes me that this thing that's 2 decades gone still is just such a recognized source of humor. I always kind of expected FTX was going to be the new Enron. Actually, the comment that was made about FTX is that their internal controls, John Rich, is that his name? He was the bankruptcy CEO, basically said the worst set of internal controls he'd ever seen, and he actually oversaw the bankruptcy of Enron as well. So, FTX is another one of those areas. Fascinating stuff going on, but not particularly relevant today. Today, we are going to wrap up risk assessment, which is going to include some topics that are very relevant to Enron and its companies that are very similar in that regard. We're also going to have a little bit of an activity in here, but we'll get to that here shortly. So remember at the end of last lecture, I said we were going to talk about the nature of risk assessment. There's a lot of ways that we can characterize risk assessment. Some of them are very, very important. Some of them are very, very intuitive. So let's talk about the intuitive ones first. So first one is going to be pretty straightforward. We talk about unintentional misstatement, which is basically errors. And these exist in a matter of the fact that we're human beings and we're not perfect. We just make mistakes. I know the argument saying, well, if we computerize a lot of the work, then we eliminate mistakes. And even that is a little bit of a simplification because the people who create the computers are humans. And if we program the computers incorrectly, then the computers themselves make mistakes. This is actually something that one of our speakers, I think it was last spring, talked about AI tools, is that AIs are trained off algorithms. And if the algorithms themselves are not particularly well written, then the AI tools may actually be poor in their judgment. So regardless of what depth of technology you're going to go into, there's going to be mistakes that happen because humans will always be part of the process. Now, naturally speaking, if we have our unintentional misstatements, then we probably have intentional misstatements as a counterpoint. What do you think another term for intentional misstatements are? Fraud. Yeah, good friend, fraud. Okay. So in this course, we're going to talk about two categories of fraud. Now, I want to preface this by saying these are not the only types of fraud that get committed in this world. These are two categories of occupational fraud that are very relevant to financial statement reporting and are the most likely to affect financial statement reporting. So that's going to be misappropriation of assets, which is basically, as it sounds, it's theft, and fraudulent financial reporting. Now, there are other types of fraud that can occur out there that are relevant to business operations. Corruption's a big one. You probably heard the Foreign Corrupt Practices Act that actually affects financial performance and operations of many organizations. But it is less relevant to reporting to auditors, so we generally do not focus on that. This is going to be our two primary focus areas. Now, just as a gauge to understand how this is, these are some outdated statistics. I actually have some more recent ones that I did in my forensics class. But in terms of frequency of occurrence, okay, which do you think happens in cases of reported fraud? Which do you think happens more frequently? Do you think it's misappropriation of assets or fraudulent financial reporting? How many people think misappropriation of assets? How many people think about fraudulent financial reporting? How many people are afraid to answer? There is no wrong answer except the right answer is misappropriation of assets occurs more frequently in reported situations by about a 10-to-1 margin. Okay, about 90% of the cases that are reported have a misappropriation of assets. Interestingly, of all the cases reported, only about 5% of cases reported have fraudulent financial reporting. Now, it's important to note that is a little bit of a misnomer because there are cases that can have both, but most cases that are reported have some sort of form of misappropriation of assets, so some form of theft. Which makes sense because theft is pretty easy. You go in, you steal a pack of gum and say, hey, free gum, but that's kind of the case. But let's go ahead and flip the script a little bit. In terms of dollar value per instance of reported fraud, which do you think is higher? Do you think it's misappropriation of assets or fraudulent financial reporting? How many people think it's misappropriation of assets? How many people think it's fraudulent financial reporting? It is definitely fraudulent financial reporting by a scale of just the opposite, about 10 to 1 scale. So on average, misappropriation asset schemes are average reporting of about $150,000 on median. That's misappropriation assets. Fraudulent financial reporting about $2 million per incidence on reporting. So by a scale of 10. And depending on the year that you look like, those figures can be even more pronounced. So frequency is going to be misappropriation of assets. Size of the incident, the dollar value of the incident is going to be fraudulent financial reporting. So it occurs less frequently, but usually far more pronounced when it does happen. All right. Before we get down into talking a little bit more about the fraud risk process and how we actually assess fraud risk in an audit, we need to actually talk a little bit more about some categories of misstatements. So I want to delve a little bit deeper. You will notice that I still call these types of misstatements. These are going to be how we categorize misstatements within the context of an audit. And it's important to actually understand when we identify a misstatement in the context of an audit, that we have to be able to say, what is the nature of the misstatement? Now, the first one is pretty easy. The first one is pretty straightforward. This is called a factual misstatement or factual misstatements. These are misstatements about which the auditor has no doubt. So an example of this, let's say your client is using an inventory method that is not approved by GAAP. They're using a market cost method of inventory, which you know is not a GAAP approved method. So you actually recalculate the inventory using a GAAP approved method, and you say the difference between what they're reporting and what that would be as if they use this GAAP approved method is X dollars, say $1 million. You know for a fact that that's the misstatement based on those criteria. Okay, you can do that calculation, and you know they're using an inappropriate method, and if they used an appropriate method, that's the difference. All right, 100% certainty on that. Then we move into less certain areas, a little bit less certain areas. Judgmental misstatements, misstatements that arise from the judgment of management that the auditor considers inappropriate. So you guys remember back in your financial accounting classes when you had to calculate the allowance for doubtful accounts, and oftentimes allowance for doubtful accounts would be based on calculation of bad debt expense. What was one of the bases for bad debt expense? Usually a percentage of sales. Okay, remember that? Am I bringing up bad memories? Just just get away. Yeah, those financial accounting, they kind of come back to haunt you. But bad debt expense. So let's say management says they want to use 1% of bad debt expense, but the auditor thinks 2% is more appropriate. Who's right in that scenario? This is an answer where we're going to say it depends. And the answer is there is no right or wrong in this scenario. There's not really a right or wrong scenario. Basically, it's a matter of judgment. Management is probably going to opt on the lower amount because they want to increase income. Auditor's going to opt on a more cautious amount. Does that mean the auditor's right? No, that means the auditor has a difference of opinion from what management has, and it's a matter of judgment over what this misstatement is. So that's a lot less certain. That is a lot less certain than saying inventory is misstated by X dollars because they used a non-GAAP method. The third process, or third type of misstatement is going to be projected misstatements. These are auditors' best estimates involving projection of misstatements. Remember, we talked about analytical procedures a little bit on Monday, and I said, could you calculate depreciation expense? So does everybody feel pretty confident they can calculate depreciation expense in this room? If I gave you the items to use to calculate depreciation, such as useful life of the asset, residual value, method of depreciation used, dollar value of the asset, if I gave you all that, you could probably calculate depreciation pretty easily, right? So if I calculate depreciation and I said it's $1 million, and then I look at what the client has recorded and they've got $900,000, there's a $100,000 difference there. And I might try to investigate and understand the nature of that $100,000 difference, but the difference between my projection and what's recorded is a projected misstatement. And it's likely that the client is probably going to be more certain about their recording because they're going to have more circumstances underlying it. Now, depreciation is a little bit of a tricky one because the projection should be pretty close, okay? But what if we're trying to do a projection on a different account? Like if I do something crazy and I say I wanted to project revenues, and I use some figures to project what revenues are, and I take I say, all right, I'm going to take some factors and some revenue estimates about participation and involvement, and I predict on trends and use percentages, and I come up with a number that's radically different from the client. It's more likely the client's going to be correct. So there's a lot less certainty when I start talking about using methods like that, especially when I'm talking about really, really subjective ones. basically what I'm trying to get to is that we start up here. This is very objective. Okay. We talk about factual misstatements. This is an objective measure. As we move down, these become increasingly more subjective. And thus, it's much more difficult to rely on saying this is an actual misstatement. It's an actual factual misstatement. So it's something to keep in mind. We will talk about different categories of misstatements. When we talk about the certainty of misstatements, this is one where the auditor can actually have a lot of leverage and say the client should make adjustments. We start talking about judgmental or projected misstatements, those become a lot less certain. All right, moving on, fraud risk assessment. Fraud risk assessment. What does this mean? Okay, what does this mean? So the first thing we're going to do is we're going to start an audit, and we're going to actually perform several steps to assess fraud risk, because we know fraud as a form of misstatement is a really, really critical one in the nature of the audit. So the very first thing is we're going to have a discussion among the audit team, okay? A discussion among the audit team regarding the risk of misstatement due to fraud. By the way, if it's bolded here, we're going to talk about it a little bit more in later slides, all right? We're going to make inquiries of management, audit committees, and others about views of fraud risk and how it's addressed. We want to consider any unusual or expected relationships that are identified in performing analytical procedures in planning the audit. Now, there's analytical procedures again. In the preliminary analytical procedures, generally, we're going to perform trend and ratio analysis. But let's say that for the prior 3 years, the company has had gross profit of 35%, okay? Every single year is right around 35%. And the current year, they jumped up a gross profit of 40%. Is that going to be a red flag to an auditor? Would that have been a red flag to you all when you were doing your financial statement analysis back in 221, when you see a gross profit jump from 35% to 40%? You'd be like, why did this happen? Why did this jump up? Why is this such a significant change? These are the types of questions we ask during the fraud risk assessment. Is this an area where fraud could have possibly occurred? Why did we see such an increase in this area? We want to understand the entity's period end closing process and investigate any unexpected period end adjustments. Why do we focus specifically on period end as an auditor? Well, if you were going to commit fraud, would you more likely do it during the middle of the period, or would you do it during the end of the period? Well, probably, especially if we're talking about financial statement fraud, it's going to be closer to the end of the period, because you're going to know particularly what your organization's performance looks like and whether you need to commit fraud to actually boost their performance. Generally, you don't have an idea of that during the middle of the period, but at the end of the period, yeah, there's going to be a lot more reasons to make adjusting entries that don't necessarily make sense. Then we're going to talk about everybody's favorite thing, the identification and assessment of fraud risk factors. And you're going to say, that does not sound like fun, Dr. Barnes. Trust me when I say it is more fun than it sounds. More fun than it sounds. So let's go into a little bit more detail on each of these. So discussion among the audit team. So the audit team is required to hold discussions, which are referred to as brainstorming sessions, about the entity's financial statements susceptibility to fraud. Now, this is a very interesting scenario, because this is one where kind of all traditional audit vernacular is thrown out the window, and everybody from the partner to the lowest associate has said, we need to identify what are some possible ways that we can address fraud for this particular client. And based on knowledge of what the client's operations and the entity and the nature of the personnel and all different factors come in, we can come up with ideas on how to best mitigate fraud risks associated with that organization. So the engagement team members should be encouraged to communicate and share information obtained through the audit that can affect the assessment of risk and material misstatement and the auditor's responses to these risks. The idea being is the better we can adapt these procedures to address the risk of fraud in an organization, the better we can mitigate the fraud from occurring in the first place. So brainstorming session is a really, really important item. It was actually advocated almost 20 years ago, a little over 20 years ago, a little over 20 years ago, which I guess technically is almost, but almost implies that it's less than. Sorry, I'm getting rambling. But anyway, over 20 years ago, it was advocated that each audit team should have these brainstorming sessions to be able to identify what are the risks of fraud associated with a particular audit engagement. Now, sounds like the auditors do a lot of work associated with fraud, and necessarily so. So if that's the case, what do you think the auditor's success rate is in catching fraud? On a percentage of all reported frauds, how many do you think were actually detected by the external auditor? What is your estimate, guys? Give me a percentage number. Anybody? Half of them? Much lower than that. Much lower than that. 2% of all reported frauds are detected by the external auditor. So what does that imply? Does that imply that we're just not doing our jobs very well? And partially could be because of that. But is the external auditor in the best position to identify a fraud that occurs in an organization? No, we come in for a few months at a time and we say, we know nothing about this organization. We're going to gain all their information now, and then we're going to leave as quickly as we came in. Who's probably in a better position to know about fraud? The people actually working at the organization, maybe stakeholders who consistently have have a relationship with those organizations. That leads into the second point. Okay, we as auditors need to make sure we inquire of management, audit committee, and anybody else who we think might have a fraud or might have a knowledge of fraud. So we're going to talk about the management about their knowledge of fraud in the entity. We're going to say, hey, what do you do to address this particular problem, and have there been any instances that you know about before? We also want to make sure the audit committee should assume an active role in oversight of the assessment of risk of fraud. They need to be actively involved in trying to make sure that risk is mitigated to as much as possible, because it has a direct effect on the bottom line of the financial statements. And probably most importantly, is auditors should consider inquiries from others within the entity and even third parties, such as vendors, customers, or regulators. All right. So within the organization is pretty intuitive. If you talk to somebody who sees something that's really weird going on, they don't understand it, that might be a place that you as an auditor want to investigate further. But how can, like, customers, for example, be an area that we'd want to investigate with fraud? Well, as we're going to see, we're going to talk about when we get to revenues, a lot of revenue-based schemes involve sending goods or services to clients that they didn't order. And if that's the case, we would want to know, when is that happening, or if is that happening to customers? If that's happening pretty frequently, we might want to investigate the potential fraud risk. Now, as a particular note here, I said that auditors are not very good on their own at detecting fraud, okay? So let's go ahead and flip the script a little bit, all right? Of all of the recorded instances of fraud that have been recorded by the ACFE over the past few decades, what percentage do you think were actually detected by tips, by internal and external stakeholders? Give me any percentage, what you want to know. It could be pi% if you want. 3.14159%. It's higher than that, though, by the way.
55.
It's a little bit lower than that, but you're getting close, okay? It's about 50%. 50% of all detected frauds are detected or reported by tips. So which would we rather rely on? The people who know about fraud, or the people who are just guessing, like the auditors? Probably the people who know about fraud. So that's why we want to make sure that we are very vigilant about reaching out to individuals who may have knowledge in this area. Okay, so something that kind of relates to what we talked about in AIS. So in 1953, Dr. Donald Cressy wrote the following: trusted persons, trust violators, when they conceive themselves of having a financial problem which is non-shareable, are aware this problem can be secretly resolved violation of positional financial trust, and are able to apply to them their own conduct and situation verbalizations that should enable to adjust their conception of themselves as trusted person with their conception of themselves as users of entrusted funds or property. You guys remember this? We actually discussed this in AIS, for those of you who did it fairly recently. Okay. This is really technical, complex, but there's a reason why I have certain areas underlined, because we can break this down into three important concepts. The first part, having a problem with, is non-shareable. We consider this to be called an incentive or a pressure. Okay, I like the term pressure, but either one's fine. Then the problem can be secretly resolved by violation of position of financial trust. So you have the opportunity to commit fraud. Okay, and then finally, are able to supply their own conduct, situation, verbalizations, which enable to adjust conceptions of themselves as trusted persons. This is the attitude or rationalization. Attitude or rationalization. Now, this is all well and good. It's easy to remember these terms, but it's much easier to think of this as a diagram. One diagram that I'm fond of, because I grew up watching Sunday morning cartoons, is this diagram right here. Does everybody recognize this diagram? This is the fire triangle, okay? This is what Smokey the Bear used to say: only you could prevent forest fires, okay? And he said this, and it was very true, because you have to have oxygen, heat, and fuel in order for a fire to occur. Now, it's important to remember this: all three elements have to be present, okay? And we're going to come back to this here in just a second. So Joseph Wells, the founder of the ACFE, kind of took this idea and said, well, let's go ahead and let's found this into a similar concept called, oops, okay, there, sorry. We actually have the fraud risk factors listed here, which is the same thing. He called it the fraud triangle, okay? which the fraud triangle basically says that pressure, opportunity, and rationalization all have to exist for a fraud to occur. All right, so this is kind of interesting with the note with respect to how this operates, how this occurs. Now let's just think about this from a classroom perspective, and I don't like doing this because I have to pick on myself, and beating up on myself is never good, but it's an easy way to think about. All right, do you all have pressures with respect to your classes, or maybe with respect to this class? Yeah, if you don't pass the class or you don't get a good grade, then you might not be able to graduate. So it's like, I really need a good grade in this class. I really need good. Okay. All right. Is there a possible opportunity that you could improve your grade through nefarious means? Like, say, for example, on the exam that's coming up in a couple weeks, could you do nefarious things to improve your exam grade? Could you cheat? Yes. Yeah, you could definitely cheat. Okay. Yes, you could cheat on your exam. Now, what would be the opportunity there? Because I'm going to watch everybody like a hawk. At least that's what I'm going to tell you, okay? Because I've got eyes on all parts of my head, not just the back of my head. So I'm going to be watching everybody while they take the exam. But maybe I drift a little bit and I start looking at my phone and I say, "Oh, that's a funny meme." Okay, that's a dog. Yeah, yeah. So I just kind of get distracted. Okay, and you have to say, "All right, he's not paying attention. I'm going to pull out my notes and all right, yeah, pressure, opportunity, rationalization. That's what I was forgetting." Okay. Certainly, there's personally going to be opportunities. Even though I tend to pay fairly close attention, there's possibilities you could cheat on the exam. What about rationalization? Rationalization. Could you rationalize your behavior in this class? I hope not. I hope you're just kind of like, Dr. Barnes is the best. I would never cheat on his exams. Okay. Some of you may not think I'm the best. Some of you may just like, he talks way too fast and only talks about cheeseburgers. Okay. He does not teach auditing. It's not fair that he teaches us this nonsense and then tests us on it. Okay. What are you doing? You're rationalizing your behavior, rationalizing behavior. So certainly can be applied in each of those scenarios. All right. Now let's think about this from an auditor perspective. Let's think about this from an auditor perspective. If I were to look at the fire triangle, which one of these do I have the most control over? Probably the heat. Okay. Because if I try to remove oxygen, everybody on the planet will die. All right. We just have to have oxygen in order to survive. If I try to remove fuel, well, that's deforestation because fuel is everywhere. We got woods all around. So what they tell you is that when you have a campfire, make sure it's completely out when you put it on there. Zero heat, because without any heat, the fire can't occur. Can we say the same thing could occur with respect to the fraud triangle? Does the auditor have any control over these? Can we affect pressure? Can we change the fact that somebody has got a financial pressure that we can't control? I guess I just answered my question. Yeah, somebody's got a gambling addiction, okay, or they need money because they've got medical concerns. We can't control that as auditors. What about rationalization? Okay, maybe to some degree I can affect your perception of me, but for the most part, if you're insistent on cheating my exam, can I change that? Probably not. What about opportunity? Can we control that? Yes, that's in fact what controls do. They address that particular risk. So we as auditors are going to focus on opportunity. That's why I try to pay at least a little bit of attention to what you all are doing. I will say there's a former professor who used to work here. He trusted his students very thoroughly. He would leave the room and just basically say, they're not going to cheat on exams. And I will say, as much regard as I have for Truman State students, that would be an opportunity that I would not be willing to accept. Okay. A level of opportunity I would not be willing to accept. So as high as my regard is for you, and it's extremely high, I have had students cheat in the past, so I have to try to be vigilant about that. So anyway, with respect to that, let's move on to the final steps. Auditor's response to the risk assessment. So if we're going to look at risk assessment, we might want to assign more experienced and specialized personnel, considering the nature of the audit. We want to consider whether any chosen policies are indicative of fraud, policies and procedures, and then incorporate in unpredictability and selection of nature, timing, extent of audit procedures. We're actually going to talk a little bit more about that later in the course. But why unpredictability? Well, let's think about this from an interesting perspective, okay? Let's say that instead of giving scheduled tests, I basically say I'm going to give tests at random. Would that be a better indicator of what your knowledge is at a given point in time? And you can gradually admit that, yes, I'm not going to change my policy, okay? But you can gradually admit it's yes. Why did I do that? Because I don't want you all to hate me, all right? I don't want you all to hate me. Pop tests are generally going to be a bad idea. But if I was curious about what the true position of knowledge in the accounting class was at a given point in time, I could say, all right, everybody pull up a sheet of paper, pop quiz, all right? Now, there's some argument there saying, well, you don't give us the chance to prepare and don't give us a chance to assess our situation and to address the particular shortcomings we believe we might have. And that's true, and that's appropriate for a class. But do we want to give our clients a chance to prepare if we think that there's a misstatement that could possibly be occurring or a series of misstatements? Probably not. So unpredictability could be our ally instead of our enemy in that scenario. All right, final steps. Has a material misstatement occurred? If management refuses to make an adjustment for a material misstatement, what are the auditor's options? Well, if a material misstatement has occurred, then we as auditor basically have to say, management, you need to make an adjustment to the financials. If you fail to do so, depending on the severity of the misstatement, we could issue a qualified opinion or an adverse opinion. One of those two are possibilities. Remember those from the first lecture? We're going to reiterate those as we go through the semester. What about fraud? Well, interestingly, fraud is not necessarily susceptible to materiality. So if we find a fraud, we have to report a fraud regardless of the materiality threshold. Now, obviously, that's a sensible intuition. If you catch the CEO stealing a pack of gum from the break room, you're probably going to frown at them, but you're probably not going to report that to the audit committee either. Okay. Now, that being said, you want to gather evidence of fraud, consider the implications of the audit, and discuss the manager at the appropriate level of audit or audit committee. All right. Now, this is actually some interesting implications with respects to what happens with management fraud. Okay. We'll talk about that here in just a second. The auditor should document the risk of material misstatement for all material accounts and disclosures in terms of related assertions, which we're going to see a lot more of that next week when we get to chapter 5. But whenever the auditor has found evidence that a fraud may exist, the matter should be brought to the appropriate level of management. So if we believe that somebody in the warehouse is stealing a lot of goods, then they're putting them in the back of the truck and reselling them on eBay, we probably want to let the warehouse manager know that there's a lapse in controls that are allowing this to happen. So we want to identify the nature of the fraud and be able to report that. Now, this is an interesting question. So what about this company right here? Okay, it's the one that I really sure of. So this company right here. All right, who was committing the fraud here? It was the senior managers. Yeah, it was the managers. Okay, it was Jeff Skilling, Ken Lay, Andrew Fastow. Does it make sense to report to senior management when senior managers are the one committing the fraud? Probably not an idea. So not a good idea. So in this situation, we're going to actually report directly to the audit committee. We're going to say, hey, your executives, they're the ones who are committing these financial statement frauds. You should probably know. By the way, it would also, if we're talking about just financial statement fraud, there could also be a situation where the executives are committing misappropriation assets. It doesn't happen often, but it has happened. Any fraud that occurs highest level of management should be reported directly to the audit committee because they're going to be our next recourse in that particular scenario. And that does it, I think, for discussion of fraud and financial statements. That's all. But like I said, we got an activity. All right. So Lucas, let's go ahead and let's get this set up. I didn't know if I had this identified already. So first and foremost, I need 3 volunteers. Okay. I need 3 volunteers. And if I don't get 3 volunteers, then I will pick out 3 volunteers. Actually, can I do it with 2? Well, we can do 3. Let's do 3. 3 volunteers. What do you guys think? All right, John, you're 1. Okay, come on up here. Everybody's keeping their eyes down so they don't want to call me. All right. Hannah, you're the second one. I'm just picking one person in the row. Alex, you're the third one. You can thank your colleagues for not volunteering. All right. So, John, here's what I want you to do. I want you to stand right here next to this pillar, okay?
Okay.
Hannah, Alex, I want you to stand a little bit over there on that corner of the room, just so you have an unobstructed view, okay? So here's what we're going to be talking about here, all right? We've got our 2 external observers right here, and they're going to be observing the activity that you all are about to do, all right? Not participating. You thought you were getting off. You guys are participants, okay? You much would probably prefer to volunteer here once you're going to see what's going to happen. Ha ha. All right. So the observers are going to attempt to identify where the waves break down. When you say, what waves are you talking about? Okay. You guys are the wave. All right. So you've been to a sporting event and done the wave in a sporting event. Okay. That's what you're about to do now. You're about to do the wave now. But it's not just going to be where you guys are going to just do one wave as an entire class with it rows. No, I would never make things that easy for you. All right. So here's what we're going to do. All right. We're in the front of the classroom, okay? And we're going to start the wave at the back of the classroom. So Ben will start the wave when I point at him, okay? And they'll move this direction. We'll come over here, okay? We hit the end over here. We're gonna move back to the second row, and it's gonna come into like a stake formation and come over here, the very end until it hits Tyler right here. All right. Is everybody good on that? Now, I'm not gonna give a verbal cue. I'm just gonna point at Ben to start the wave. So let's do a very simple one. You guys ready? And it's a snake formation. It goes just like this. All right, here we go. And if you feel like you don't want to participate, remember you are being graded on this. All right, that was good. That was good. Okay, that was pretty good. Now that was just one wave. Let's see how we can do with multiple waves. All right. So we're gonna see. You guys agree that one wave started and one wave ended? Actually, let's specify. Hannah, you count the number of waves that start. All right, Alex, you count the number of waves that end. Okay. So we have an alignment of 1 and 1. Okay. All right, good. All right, here we go. We're gonna do it again. Ready? All right. So how many began, Hannah? How many ended?
I had 3.
At 3? All right. And technically it should have been 5 because Ben wasn't watching when I pointed. All right. So yeah. So not bad. Not bad. I think you guys can do better. I think you would do better. But you know what? Let's amp things up a little bit. What do you guys say? Let's ramp up the difficulty. Oops. Oops. Here we go. There we go. All right. There we go. We got 2 waves now. All right. So now not only am I going to start the wave over here with Ben, but I'm also going to start another wave over here with Meg. All right. So if I point over here, the wave starts with Meg and goes the opposite direction. Okay. All right. It ends over here with Joseph. All right. So let's go ahead and let's try integrating series of waves. So again, when I point with my right hand, Ben starts a wave. All right. Point with the left hand, Meg starts the waves. Are you ready? All right. Hannah, how many do we begin with? How many do we finish? Oh gosh, guys. All right, come on, come on. Really counting on you guys to do this well, okay? So you need to put it serious. All right, points are on the line here. Points are on the line here. So this is the test, all right? I've given you the parameters of the assignment, parameters of the engagement. You need to actually meet the parameters of the engagement, all right? So we're gonna try one more time. Ready? All right, how many begins, Hannah?
I think it was 7.
Yeah, how many did we finish?
5.
All right, you guys, you have failed me for the last time. All right. My external observers can sit down. All right. All right. Not my auditor though. Okay. So John, you are stuck up here. Okay. You are stuck up here. So before we talk a little bit to our auditor, let's just go ahead and do some classroom polling. All right. Obviously, this is not an optimal exercise. So what are some ways that we could have improved the process to reduce failure in this exercise? Any suggestions?
People on the ends had like just an easier way to like what's going on.
Oh, so starting the back was kind of an impediment because you had to like look over your shoulder to try to see where things going. Okay. Yeah. All right. So I would agree. Then maybe something even simpler. We could just say start in the front. That way we could see the move in the back. Okay. So that was kind of a problem. All right. Anything else? So are the physical cues, are those very helpful? Could I do verbal cues? Would those be a little bit more helpful? Yeah. Anything else? There's probably hundreds of these things we could come up with, but I wanted to kind of see. What about, sorry, go ahead, Tom.
Oh, Andrew had a good idea. We just do one hand per direction, all right hands if it's coming from this way. all
Okay.
right hands.
That's actually the first time that came up. That's a pretty good suggestion. Okay. And I've been doing this for a while, so that's a pretty good one. All right. So some good suggestions, some good suggestions. So can we agree as a class that there are definite ways to improve this exercise? All right. Now hold on to that. I want to think about this. All right. Going to talk to our observer, which you're going to be our auditor here. John, are you ready?
Yeah.
Now, we know that the observed failure of this exercise is a function of its components, in this case, the students in the class. So Hannah counted 5, we only, or to 7 start, we only finished with 5. So somebody out there failed. Okay, you're gonna identify that failure, okay?
Okay.
So we need to address the causes of failure. Here's the thing. I want you to identify 3 students you believe are responsible for failures in the wave. These students will receive no credit for today's in-class exercise, and it's worth 5 points, okay? So you have to pick out the 3 students you think are most responsible for that. That seems really, really awful, doesn't it?
Yeah, a little bit.
Yeah, so that's option number 1. Option number 2, I'm thinking of a number 1, 2, or 3. You guess it correctly, everybody gets full credit today's exercise. If not, everyone in class loses 2 points for today's exercise. So what are you gonna do? Are you gonna pick out 3 people, or are you gonna just try to take a lucky guess here?
I'll take the lucky guess.
What's the number I'm thinking of?
Not,
Yeah.
I'd say 3.
It was 2.
It's always.
It's always, it was 2, and I wouldn't change that on you. All right, so everybody's gonna lose 2 points. All right. Yeah, that was really unfair, wasn't it, John?
A little bit.
Yeah, you can have a seat. Yeah, it's not fair. All right. Let me let you on, okay? First and foremost, what our observer, what our auditor selected, okay? Everybody's gonna get full credit to today's exercise, but that is contingent on you answering a few questions, okay? So I don't want you getting mad at John. I put John in a very, very uncomfortable position, but I did that deliberately. So if you're gonna get mad at anybody, get mad at me. Start writing out your evaluations right now, all right? Let's talk about this. What's going on here? What's going on here? So this exercise was extremely complex and susceptible to consistent failures. From an auditor perspective or audit perspective, what does the wave exercise represent? So we can say that there's innate complexity in the wave, the way that it was designed. Okay, it went like an S. It wasn't like a wave in the stadium, which is like, oh, everybody's standing up. Yeah, we actually went to an S, and then the second S in there, and we have to do that. And it looks like it was kind of designed to fail. What concepts have we talked about in this chapter that this kind of emulates? What inherent concept have we talked about that this emulates? I can't make it more plain than that. Inherent risk, yes, inherent risk. The nature of the activity has associated inherent risks with it, okay? All right, the way that it's been designed, it inherently is complex. I could make it a little bit easier, but for the way that it has to be set up, is going to be inherently challenging, okay? But we know about the nature of risk. So let's move on to the second question. Recall the crossing poll where I asked you for ways to improve the process, okay? We talked about it. We had some interesting ideas about raising one hand versus the other hand, depending on the direction the wave is going, or the direction of the wave is moving, or vocal cues or stuff like that. From an audit perspective, what do these improvements represent? What were you all implementing in response to the inherent risk of the wave exercise? You all were implementing controls, okay? You all were implementing controls. So you identified that there were risks, there were problems with the activity, and you're trying to say, let's mitigate those risks as much as possible. And say, let's figure out what the problem is and see if we can fix those problems. So this kind of reiterates that important point that there's an inherent, I shouldn't say inherent association, there's a natural association between the identification of risk and the implementation of controls, which will come up and become very prominent a little bit later in this course, but something you should already be aware of. The most important one I want to talk about is what I did to John. And John, I hope you forgive me, okay? I had to pick on somebody here, okay?
It's not taking.
All right, yeah. You seem to be the most trusting of me. That's why I didn't pick you, Pendra, because the Pendra would immediately throw me under the bus. Yeah, so all right. So our auditor was put in a very uncomfortable position of having to impose a penalty on people in this class. All right. Now, keep in mind, the nature of this penalty was twofold. Either John had to pick out 3 people and say, yeah, you guys are the ones responsible. And even if it wasn't somewhat sanctimonious and random, because I think it would have been very hard to identify 3 people who are truly responsible for it. All right. Even if that's the case, that would have been mathematically more correct than what he did. Think about it. Okay. There's 2 points going to be removed from basically a 66 and 2/3 chance that everybody will lose 2 points. So there's 22 people in the class. That's 44 points, and 66% of that would be basically around 30 points. Okay, around 30 points would have been lost, or were lost, quote unquote, were lost by that choice. If you selected 3 people to lose 5 points each, that's half of that. That's 15 points. Okay. So from an expected value perspective, it was specifically a wrong decision. Okay. And I will tell you right now, you are not alone. In the times that I've done this, I've had 2 people that have actually chose to pick out people in the class. Okay. So I've been doing this for going on 10 years now. And almost every person says, I'm going to pick a number between 1 and 3. So you're not alone in that. So don't feel bad about that. But from a respective value perspective, it's completely and totally the wrong answer. By the way, just as a note, the way that it worked out is one person, she selected her friends and she said, they'll forgive me. Okay. And the other person called my bluff and said, yeah, you're too nice a guy to actually deduct 5 points for every person. So yeah, she actually called me out on it. So 2 people have actually done that in the past. But how does this relate to an auditor's responsibility in the real world? Are you ever going to be given a scenario where it's kind of like, well, I've given 2 options and both are going to be penalized? And the answer is kind of, all right. But it may not necessarily be as apparent as that. Now, I want to put forth a scenario that is going to be a very uncomfortable scenario, but I want you to think about this and think naturally. Let's say that you're going out to a client. And the reason I mentioned this specific scenario is this scenario actually happened to me. So you're going out to a client, it's the middle of a small town in a very large state, but you're kind of out in the middle of nowhere, and you're auditing a regional company that's very important for the economy of that particular area. And you walk in and you go to talk to the CEO of the company, and you talk to the CEO's administrative assistant, who's responsible for a lot of the information that gets sent to the CEO and the administration of detail. Very, very sweet person. I'm gonna characterize her as sweet little lady because that's what she was. Okay, sweet little lady. She's very polite, very nice, very, very conscientious. Every time she sees you, she has a greeting for you. She even brings like cookies that she baked at home and she shares them in the office and she shares them with the auditors, which nobody ever does that. No one shares with the auditors ever, but she did. Okay. And you start performing your test work and you start talking about, all right, they implemented a new accounting system 2 years ago, but you're still operating on the old system. Says, yeah, I don't like the new system. I just like doing things the old way. That's what I'm comfortable with. So yeah, I just continue doing things the way that they were. And as a result, there's been many material misstatements as a result of those actions. So that's the failure in the control right there. What is your responsibility as auditor? You have one choice or 2 choices, okay? One series of selections. You can actually say, this is the control breakdown, or you can ignore it and just basically let them go on as they have been and saying there's no problem. Are there costs associated with both choices? Doesn't seem like it. Say I could ignore it and you could say there's no cost associated with it. But what if those misstatements continue to compile? She just continues to use the same system and those transactions don't get recorded and the misstatements continue to abound. That could end the company in all possibility if it's ignored for a long period of time. It sure sucks telling a sweet little old lady who brought you cookies that you have to let go because she won't update her procedures or her protocols. You know, you're not going to be the one to say that to her face, but you're going to have to go to management and say, yeah, we talked to her and she's just adamant about not doing things differently. And so that's going to be the case. And I don't think most of you will run into that scenario. To be honest, that's a little bit of an exaggerated scenario of what I encountered. It was very similar, but it's kind of the scenario that you may encounter. There are social pressures that are going to be subject to you. The social pressures have a cost associated with them, but not following what you should be doing also has a cost. And oftentimes those costs are not necessarily visible. So that's one thing this story kind of tends to illustrate, is that it kind of sometimes sucks to be an auditor, but you have to do what's right because you're doing what's right for a larger body of people that are not present. If you try to do what's right for the people who are immediately in front of you and they're a small quantity, then it's easier, but it's just generally the wrong thing to do. Anyway, with that pleasant note, I will leave you with the finish, and we will reconvene for homework on Friday. So I'll see you all then.
Oh, I would say something.